Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today is the man himself, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. How's everything going with you?
Great, doing great. Talking about doing things that are great and well-meaning and with a great purpose is SPI's charitable activity for the year is coming up here shortly. And tell us a little bit about what you guys over at SPI do.
Yeah, I mentioned last few podcasts that we're doing something called Par for a Purpose. So it's a little top golfing tournament for to help support Bogle Alcove, Dallas-based charity that helps kind of homeless kids and their families kind of get stabilized and give them some resources. So a pretty good charity. I've been on the board for about the last year and now got promoted to the chair of the fundraising division too on that committee. So taking my skill sets of raising money to buy apartments and hopefully help that charity out. So definitely appreciate everyone that's investor of ours and vendors and sponsors that kind of help support. We're already up to $30,000 raised with this one event. We'll have a couple auction items, so hopefully get to around $35,000 on this one event alone, which is go a long way to help them out.
That's great. Good for you and your investors and all of our friends over at SPI. You remember if we went back 50 to 100 years ago, the act of war was different. And we went back 1,000 years ago, the act of war was different. And everything comes with communication, that the guys at the front lines have to communicate to the people in the back, so to speak, that are making the decisions of which way the troops should go, to the right, to the left. And so we're talking with Michael today because he is on the front lines. So his information is going to help you hopefully make decisions of what you're seeing out there. So the question for Ask Mike Monday today is, Michael, what are you seeing on the battlefields right now?
Yeah, I wasn't quite sure where you're going with that, but I guess you brought it all together there. So that's a good one, Paul. Yeah, like as we're sit here, to kind of frame it from my perspective, I sit in Dallas and we have an awesome office as well. And we focus on, properties Dallas, also San Antonio, and we had a few deals in the secondary market, Tyler, and we're really focused on Dallas and Austin right now, predominantly for new activity. And have about 30 assets, give or take today, about, billion. I don't even know what anything's worth anymore. Billion, 2 billion, three in valuation, maybe something in that ballpark. And we started workforce housing and transitioned over the years. So the vast majority of the portfolio is kind of 2000s and newer. So anything from, kind of A minus, pre-Great Recession to, brand new buildings we bought from the developer. So that's kind of my lens of the world that I look at, and you're really kind of seeing we've sold a few deals this year, or sold a deal this year. I have a couple about to close, that one in escrow, one we're on the market. So I kind of speak about what that looked like, and then we're actively trying to buy. So from the perspective is like, it seems like short version is like we're back. Like Paul, it's been winter for 18 to 24 months here, and we're definitely in spring again. So winter's over, spring is here. From the class A to A minus stuff, I think maybe still a little chilly back in the 70s workforce housing stuff, and probably a little warmer in the 80s workforce housing stuff well located. But we couple of data points. We sold a deal in Tyler. We were the equity on, and that closed maybe in February, I think it was. Agreed in December, and it was a 70s deal, and I think we were around a high five to maybe a six cap, and we thought that was pretty good for a old deal in a secondary market. So we took that, got that skin on the wall. It's not as high as it would have been if we sold it earlier, which is kind of, across the board, thinking that the secondary markets probably have a little more room to have cap rates expand relative to like the primary markets. And so we thought that was a pretty good trade for us. And then we have a deal. We did a two property portfolio back in early 2019. One property just south of Austin, one property in North Fort Worth. And we went to NMHC kind of with both of them as kind of like pocket listings. And the broker in Austin was a little bit more polished with his and the way we did it on the Fort Worth deal. And he went out to 25 or so, the top buyers. And we ended up cutting a deal. What I thought was a pretty good price. We're probably in the 5.25 to 5.5 cap range, Paul, but it's a profit. Not the profit it would have been, but pretty reasonable profit on a deal because we bought it pre-COVID. and that deal's closed on May 22nd. That was we had a note they could assume on it, and so that deal's going, and we agreed to sell that deal. Like we decided we should just go full market, the Fort Worth deal. So that went out to market maybe six or so weeks ago. Probably in mid March is when that deal kind of really went out, and it was plus minus kind of the high 40s was kind of what he was whispering for price. So kind of plus minus 50 million. 2009 product, and good suburban, one of the better school districts up there. And we have renovated approximately 35% of the units, and so 65% were still left to be renovated. So it had quite a bit of value add left in it. And the thesis at the time we decided to go was like, this is kind of based on every conversation I had with equity partners at NMHC and many meetings outside of that. The center of the bullseye for what people were looking for, equity wanted, was 2000s and newer, 9-foot ceilings, light value add component, and suburban good school districts. So this kind of checked everything. And then we also felt that being around 50 million, it was going to be well received because it was big enough that some of the larger groups that are kind of coming off the sidelines will kind of dip down and look at, because it's big enough they can look at it, but it's small enough where some of the more regional players could jump up, and it's not such a large equity check that they can, it's attainable. It's not like an $80 million deal where you have to write a $35 million check or something like that. It'd be around plus minus 20 million in equity. So that was kind of the thesis. And in normal times we put a deal on the market, we're hoping to get kind of 30 to 35 tours. You maybe get 15 offers, and maybe two to four of them at the very top, and you do a best and final and kind of pick a buyer. That's kind of your normal times. We were hopeful that we'd have like 50 tours when the thing kind of went out, just because there's a little bit of a scarcity right now of this type of product in the marketplace. And so what happened was we ended up getting 72 tours, almost 50 offers, and got to the top of the range that the broker wanted. And while we were on the market, the 10-year treasury went up about 50 basis points. So if for the 10-year treasury not moving 50 basis points, I think we would have exceeded the top of the range that the broker had kind of put to us. So it was the deal absolutely exploded. It was the hottest deal in probably Texas, or certainly Dallas Fort Worth. There got a ton of attention, and we picked a buyer recently and are about to get into contract. So it was very heartening to kind of see the response, Paul, on that. So I've been rambling. I'll let you ask me a question on what I just said.
So talk a little bit about that. I mean, these properties, these two deals, the one in say Austin, a little south of Austin, the one here in Fort Worth, distress deals. Were you guys making your mortgage payment? Was the occupancy at 70%? I mean, why were you guys deciding to sell right now?
No, I mean, everything was fine. I mean, one of them had a fixed rate mortgage. One of them we had a floater, but we had bought a rate cap and had plenty of term, and there's no real distress. And they're both in the low to mid 90s always, and occupancy, and paying distributions on both. So there's no issues like that. We kind of looked across the board, and felt like it was going into the year, it was important to deliver some liquidity back to our investors, and kind of looking at deals that you had a profit, and that you can return some capital to the pool. And so then you got to look at the deals you bought pre-COVID mainly. So that's kind of like subset of the portfolio we had. And these are deals that we're basically 5 years into, and we had a 5-year initial business plan. So we thought that it would be, if we get reasonable pricing, we can ring the register. And we started with a south of Austin deal, and we got pretty good pricing, because we had a 419 fixed rate mortgage with a little over 5 years left on it. So that was accretive. So we did that. So that was helpful. And then we decided to just go wide with the other one. So which is really about returning. You got to kind of restock your own pond from time to time, Paul. That was
Yep.
the main reason there. And then it was just like there's not much out. So it was like we had kind of from every conversation, what the vast majority of the equity wanted were kind of the profile of these deals. So that's why we decided to go with these two deals.
Yeah, I go with the philosophy is the customer wants a green suit, you give them a green suit. the market wanted to have inventory that was higher quality, that these properties were stabilized, but they still had some meat on the bone for the next buyer to have.
Yep.
And so they were not distressed. I would imagine your investors who have gotten paid in distributions, maybe they didn't want to sell, but you felt in the bigger picture it was more important to say raise some liquidity and pay out. I mean,
Yeah, I
people,
think the bulk of them did. A couple were like, "Why are we going now? Values are off the peak," which is true. But from a macro standpoint, say we own 30 assets, Paul, we sell two of them, and the market rips. Well, I got 28 other assets we're gonna benefit from.
yeah,
So, but if it's middling and stays in this purgatory that we've been in for the better part of the last 12 months, it's been hell before that, purgatory now. It'd be nice to have a couple dollars in your pocket to go, do whatever with, and then we can redeploy in today's
yeah,
environment as well.
buy something more. Did you have? Do you think you got a better price by having somebody assume that 4.19? Did you say that was a fixed
Yes,
rate? Do you think
we
you?
definitely did. That was accretive in that scenario down in Austin for sure. The other was a Freddie floater that we offered up, and that was not accretive to anybody. No one really wanted that, even if they could synthetically put a rate cap on it. It for sure the sentiments changed, and that's pretty much all last year and continued this year. The best execution is getting a 5 year, maybe a 5 to 7, but particularly the 5 year Fannie Freddie fixed rate around 65 lever. That's like the playbook everyone's playing right now. That's what the marketplace is doing when it makes sense.
So on my side, we hear a lot of people that only want to buy distress assets. And it sounds like what you're saying is that the people that are buying your stuff, and they're not buying distress assets, they're buying kind of light value add, stabilize, higher quality assets. What do you think about the C product and the B minus stuff? Is that more of a distress asset than versus in the space that you guys are currently in?
Yeah, no doubt. So yes, and you're starting to see more of that inventory, and we've been thinking that would have happened earlier. God, just go listen to the stuff I said 12 months ago, and I thought I would have been here by now. But you're really starting to see that start a little more, but it's not like the floodgates aren't open. This is not 2009, where it was a disaster. You're seeing several deals on the market that the sponsor has a rate cap that's coming up in the fall, and they're like, I don't want to buy this $1 million rate cap. I'm going to sell it at today's price, and I'm getting a BOV that's slightly above my debt or around my debt, and I'm just going to clear the deal. So there's several of those deals on the market, and then we'll see kind of how pricing comes in. But no one's really pushing pricing if it's a 70s deal. So like I think if it's January 1 of 1980 vintage versus December 31st of 1979, that's like a pretty hard line in the marketplace for whatever reason. If it's 70s, it is definitely a higher cap rate than if it's 80s. So your generic mid 80s deals probably in Dallas Fort Worth pricing in your 5.5, maybe touch above, maybe a touch below, but probably call it a 5.5 trailing income, 100% tax adjusted with an actual insurance quote. That's your cap. If it's a 70s deal, it's certainly north of 6. If it's a deal in the hood or, got a chiller or something like that, I don't know exactly what the cap rate is. None of that stuff is clearing because the market doesn't want it. So the clearing cap is certainly north of a 7 by and large. And so that's kind of what you're seeing. And then these class A stuff, you're 5.25, we'll call it probably market cap. And if it's got some competition and some upside, I think we probably touched a 4 handle on our cap rate after it got competitive. Probably there. Like that's your cap rate. Then that's Dallas. And then you go to Austin. I want to say Austin's toxic to equity right now, but Austin is definitely out of favor for equity. What you're seeing is, probably, historically Dallas Fort Worth and Austin. Austin would trade at probably a 25 basis point lower cap rate than Dallas. Dallas would have a higher cap rate. And then within Dallas Fort Worth, historically, you have Fort Worth probably, 10 years ago, Fort Worth was a 25 basis point higher cap rate than Dallas. And that's maybe shrunk to 10 or 15 basis points nowadays. But right now, a deal in Fort Worth is definitely, I'd probably say 50 basis points lower on average than a deal in Austin. And that's,
Wow.
historically backwards, probably, 50 to 75 basis points the other way, so it's probably a 100 basis point swing to historical norms from the relative value. And that's what you're seeing is because Austin has like with 50,000 units under construction and a apartment market with 250,000 units. They've delivered 20 of those or so, and there's another 30 under construction. So it's going to be a little bit more of an overhang in Austin. But I mean, the same deal in Austin that it's probably 10-15% cheaper than a deal in Fort Worth, and maybe 15+% cheaper than a deal in Dallas right now. And so it feels like a lot of that's priced in, to be honest with you. We're more excited about what we're seeing in Austin because the rents have declined and you have a lower rent. And, you're seeing the supply taper. Like it's impossible to capitalize a deal in Austin. It's very difficult to capitalize a new construction deal in Dallas, but it's like impossible to do in Austin. So there's gonna be a hole and it's gonna swing, and it's just a matter of when, not if. And so that's kind of what we're excited about. And we're bidding on a deal down there, and we're going up against 3 or 4 people where there was like 20 people really banging out for my deal in Fort Worth. So that's kind of what I'm
Wow.
seeing, just talking real time.
Yeah, that's great information from the front lines. So you guys bought a couple properties, one just south of Austin that you're selling, and then you're selling this deal up in Fort Worth, and you're almost agreed to on this. So you planted your trees back in 2018, 2019. The fruit has come, and you're about to pick the fruit off the tree. You'll raise money on the sale of these two properties or so. And would you like what you're telling me is that you would want to maybe go into Austin because maybe it's out of favor right now versus trying to find something immediately in Dallas?
I'd buy
Would
Dallas, but Austin is definitely the on sale relative. So,
Yeah,
like I think of this, Paul, everything's like relative to everything else.
yeah,
So, like, what's the relative value at the moment? So there's always a deal. You can always find a deal. And I love Dallas, and Dallas has better fundamentals right now. And then in the, next 12, 24 months, the fundamentals in Dallas are going to be better. So I think anything you buy in Dallas, you're going to be doing fine. But if I'm in Dallas, I'm probably skewing a little older in vintage because that's still out of favor. And the newer stuff, like we're off the bottom. I mean, like, anything 2000s or newer, it was October 23rd of 2023 was the bottom. That's when the 10-year treasury hit 5%. So that's the day the bottom happened, and we're off the bottom, a margin already, and it's going to continue to go up until, till it doesn't. But, we have years of it going up from this point forward is my view. And then this 80 stuff seems like that's probably bottom, and we're probably a touch off the bottom. I'm a little less confident in that statement. And then the 70 stuff, I think the bottom's in. I think it's the concept I've said before. There's a lot of dead bodies, they just haven't fallen. So,
yeah,
these people is like a lot of stuff below debt basis on those things that were debt fund deals put on in 2021 with 3-year maturities that are all like coming due as we speak. So those deals, are going to start clearing a little more. You're hear of I won't name names, but the largest, one of the largest buyers in Texas, a couple groups went, absolute bananas in 2021. Bought way too much stuff, didn't have any control or structure coming in from out of town, and levered all the way up to their eyeballs. And you're seeing more and more of those deals kind of get posted for foreclosure. If you read the real estate news, everyone will know the groups we're talking about. And those are, I think, in Tarrant County, one of those groups has like 5 to 7 deals posted for foreclosure next Tuesday. First Tuesday of every month is foreclosure day in Texas. And so, some of those are going to start going back. And then, but the lenders aren't really, like, from what I hear, I haven't been doing much of that. So we're not necessarily getting the calls from the lenders. But one of my buddies I was talking with yesterday that is kind of hearing that, and the lenders are like going to sponsors kind of similar to myself and, saying, hey, will you take this over? But, they're not really willing to sell below par on their debt basis because the debt funds are still raising money to redeploy. So if they start marking stuff down below par, then it's going to screw the whole book up and their CLO collateralized portfolio. And then they're going to sponsors and saying, hey, we do this for some fees and maybe a tiny little kicker on the upside, but like you're going to take on a sinking ship in a disaster for a couple dollars in fees doesn't make sense to me. I'd rather just go buy the deal. So if the group has, a little less things going on, that might make sense to keep your lights on. But that's kind of what you're seeing. So the banks aren't really, or the banks or debt funds aren't really willing to take the below par by and large. So that's not happened yet. So I haven't really seen the distress like really be in a price to move yet. So that's probably going to happen at some point, but it hasn't happened yet, Paul.
All right, you threw a lot of terms that maybe people don't understand about par and things like that. So let's go back on that just for 1 second. So what you're not seeing is a lot of the banks declaring or showing that they want to put this property in foreclosure, and because the property is now worth less than what the loan dollars are against the property. Is that what you're saying?
Yeah, they're not willing to sell below their loan balance.
So they're not willing to charge off two, three, $4 million. So if they have a property that's worth $20 million and they owe the current borrower owes $25 million, they're not willing to write off $5 million of a loss or recognize the $5 million of loss. At least right now, what they're saying, I think, to some guys is a lot of the lenders are almost becoming brokers right now and calling guys like Michael, not so much Michael, but maybe some of his friends and his groups on these older class B minus C plus properties, Michael or Mr. X or whoever is going to be wanting to buy that is somebody that maybe owes 15 different properties that has a proven track record. Hey, listen, come on over. You can just buy this property of what's owed against it, but you don't really have to come up with very much equity. In fact, you may not have to bring any equity in, just take the deal over what is owed against the property, and maybe we'll float you some rehab dollars or we'll put a little interest reserve in there for you. And so you don't have to bring in 20 or 30% of equity. Just take over, assume the current loan that's against the property. In that case, they don't have to recognize, the lender doesn't have to recognize that loss. So they're negotiating on some parts to not, as I would say, kick the can down the road a little bit so they don't have to recognize an immediate foreclosure that translates into a significant loss for the lender. So what else are you seeing out there, Michael, before we wrap this up?
Yeah, that's a good way of saying that. So yeah, I mean, I think that we're Dallas and Austin, that's Fort Worth, Austin are the two focuses still. I think Austin's the relative value as we speak right now. And then Dallas, I think the relative value is starting to come in the older vintage. We're bidding on a few things and we're, not like super committed or super convicted yet on that call. So we're being cautious and kind of seeing the field ahead of us and seeing kind of how these things kind of play. We're not like super leaning in. Where like in Austin, there's a '07 vintage deal. I'm hopeful that I get that we're like leaning in. I think the major sentiment, one thing that's abundantly clear versus say 6 months ago, there was if there was an A minus an A deal, and there's a few groups bidding on it. These groups are like, this is my number. I'm not moving. I will lose this over $100,000 into a $50 million deal. Where now it's like, I don't want to lose this over $100,000 or $250,000. I'm willing to like move. So like we're seeing buyers want to try to find a way and push to win the deal versus just drawing a line in the sand and saying, I'm not doing it. That's abundantly clear. The sentiment has shifted 100%. And then, I'm certainly no expert here, even though, you call me Dr. Beckers in college for 8 years, but, and I'm not a doctor, but like, more like Tommy Boy than a doctor. But, looking at what Jay Powell said at the most recent Federal Reserve meeting in May was that, he basically reconfirmed that the hikes aren't, is going to be something dramatic for them to hike. So the high watermarks in on rate is just, when do they win and how quickly they cut is really the question here. So, that seems to take like the, catastrophic scenario largely off the table from a rate standpoint. So I think that's going to make the sentiment even more bullish because what I just told you happened all before that basic point is made in the marketplace. So I think the sentiment's going to continue to improve. So more and more buyers are wanting to buy. So now we see, I'm hearing that there's going to be more and more inventory come on. So we'll see if there's going to be more supply than demand in the grand scheme of things. I don't think so. I still think that demand is going to outpace supply, and we start seeing pricing continue to go up in your 2000s and newer vintage stuff, probably even your 80 stuff, and then the 70 stuff. Still think you got to clear all the sins of the past out, and that's going to be the last thing that moves. And then, Austin, I think, is going to be a little slower. So the window's a little wider and a little longer in Austin than there's in Dallas. That's what I kind of see right now. That's my read of the market this moment in time.
Well, you are on the front line, so we appreciate all the information that you're pushing out to, potential investors or people that are wanting to get into
Yeah.
multifamily and, and kind of learn about what's going on. If people want to learn a little bit more about what SPI does, what's the best way for them to get in contact with your group?
Yeah. Well, the best way is our website, which is spiadvisory.com. There's a contact us form. And what two other quick thoughts too, Paul, just kind of popped in my head.
Yeah.
Seems like we're like days away from seeing our insurance renewal on a good chunk of our portfolio. It seems like the bloodbath is over there as well, that we're like going to see, flat to very, single digit increases on a percentage basis. It's not going to be 40% like the last 3 years in a row compounded.
Mm-hmm.
And then in Central Texas, Travis and Williamson County was flat and even in some cases down on their notices for taxes, where every one of the county appraisal districts are smoking crack up in North Texas and Dallas County in particular. I don't know what they're on in Dallas County or Denton County. They really jammed up values like 10%, which was like insane. And Travis County and Dallas County is probably closer to Tarrant County was 10%. Dallas County was probably closer to 15-20% over 2023 values that we haven't even settled. So we're going to go backwards, there's no doubt about it, but they came out swinging. So if you're in the middle of a financing transaction, that's not going to help Paul Peoples in the meantime until we get these numbers down.
Sure.
So it's gonna be a little more challenging from that standpoint, but it looks like the agencies are both realizing they're going to come down and they're sizing the loans off of, if it's a purchase transaction, at 100% of the purchase price. So that's kind of the value they're using when they're sizing the loans. That seems to be consensus that every buyer in the marketplace is essentially underwriting 100% of taxes, 100% of purchase prices taxes, where, if you go back 5 years ago, was kind of 80, 85, 80 to 90, with 85 kind of being your average. A purchase price is what you kind of underwrote for taxes. So today it's 100%. And that's usually lower than what the assessed value is on the tax roll. So those are two other kind of things I've seen like in real time right now.
So some dynamic thoughts from a guy who was on the front lines, Dr. Michael Becker. And again, air quotes with the DR in front of Michael Becker. So, so again, Michael, we certainly do appreciate you spending some time with us at Ask Mike Mondays. I'm Paul Peebles. Have a great day.